Hello everyone, hope you are all having a great day. My name is Ryan Wagner with Black Diamond Mergers and Acquisitions here in Kansas City. In this month's video, wanted to address a topic that many are unfamiliar with when it comes to buying and selling a business, but that can have some pretty significant consequences if not handled properly. And this is the concept of net working capital and a net working capital adjustment when it comes to closing a transaction. First, to understand these concepts, we have to understand what net working capital is. At its simplest form, net working capital is simply current assets minus current liabilities as found on your balance sheet in the financial statements. Current assets, of course, are things like accounts receivable, inventory, prepaid expenses, etc. Sometimes this calculation can include cash. We'll get to that in a second. Current liabilities are things like accounts payable, accrued expenses, etc. So the net of that is what's called net working capital. And overall, this is a measure of a company's liquidity, operational efficiency, and overall just a picture of a company's short-term financial health. A positive number for net working capital indicates that you are able to fund going forward operations and maybe have some leftover liquidity to fund growth, pay yourself a dividend, whatever the case may be. A negative number obviously is the opposite of that. Means that you are unable to fund going forward operations. Maybe you have to come out of pocket with a little bit of cash to help cover expenses, things like that. So, okay, why did I make a special mention of cash? So for all the accountants out there, or somebody that took an accounting class like me, cash is technically a current asset. Now, in the formulation of net working capital, we don't typically include cash in that calculation because cash is not a part of a business's normal buying and selling operations, right? You could have cash on the balance sheet for a variety of reasons. Maybe you're building up cash reserves for any unexpected events, similar to what you would do personally. Maybe you received a short-term loan. Maybe you paid yourself a dividend and cash is lower on the balance sheet. So there's all kinds of different reasons that cash can exist on a balance sheet, but what we're trying to get is related to a business's normal operations. Okay, so when it comes to M&A transactions, why do we care about this? So most transactions have a mechanism to adjust the purchase price after closing to accurately reflect the value of a business that the buyer agreed to buy and the seller agreed to sell. And what this does is protect against unforeseen events that may happen right before closing. So, for example, let's say that you incur a big expense right before you close. Something broke in the business. You've got to order a spare part. You've got to hire some contractors to do some work. Whatever the case may be, this is an unforeseen expense that likely the buyer was not expecting, but if it happened right before closing, likely the bill hasn't been paid on it yet, and the buyer would be stuck paying that bill after closing. So a net working capital adjustment is meant to protect against something like that. Now, similarly, with sellers, to protect sellers, let's just say you signed up a big customer right before closing and you're expecting a big revenue windfall at some point, but the monies haven't been received yet. Well, because that happened before closing, you would expect to reap the benefit of that. Another unforeseen event, just like an unforeseen expense would be, an unforeseen revenue stream, potential revenue stream, would be another one. So how do we protect buyer and seller from these events? Well, this is accounted for in what's called a net working capital adjustment. And usually this happens after closing. So we need to take another step back to figure out why this is important. When any buyer is evaluating a business and the economics of a business, usually what they try and do is normalize the operations so that they can get a picture of what they can expect going forward. So when you look to the past, you look at things like maybe they had a great year. Well, that was just 1 year. Maybe that was an anomaly. So they would kind of try to smooth that out, and maybe they only pay for what a normal year may look like. Well, let's say something like 2020 happened, where a lot of businesses were impacted by COVID. That would be another anomaly in a business operation that tries to get normalized when you make an investment decision. Well, the same can be said with net working capital. So what we try to do when signing up a purchase and sale agreement is sort of find what is a normal level of working capital that could travel with a business that the buyer could expect to receive when they close. And there's a lot of different ways you can do that. Some companies just take the trailing 12 months, some take the last 2 years. There are some traps in there with those methods because, let's say there's been some significant changes in the last 3 or 4 months with a business that's expecting to bring in a lot more revenue, thus your receivables would be higher, and so maybe the normal level of working capital is shifted a bit. Well, so you gotta think about those things when you're developing this normal level of working capital. So step 1 is in the purchase and sale agreement, you determine what your target working capital balance is going to be, target net working capital balance. And that is usually based on what's called a normalized level of working capital. That number is usually found in a purchase and sale agreement and serves as sort of the guidepost to any of these potential fluctuations that we talked about previously. So then what happens is right before closing, so remember the target is established in the purchase and sale agreement. Right before closing, a seller will usually try and estimate what they believe the closing date net working capital is going to be. Now, why is it an estimate? Well, it's very difficult to determine with exact precision what your closing date net working capital is going to be because there's still outstanding, accounts or debts that need to be settled. You're paying your electric bill. Maybe it was a hot day right before closing, or you're making an estimate because it's really, really hard to say what exactly that closing date net working capital would be. So there's usually some period after closing, 30 to 60 days, where you then go back to the closing date and determine, okay, what was the actual level of net working capital? And that actual level is compared to the target that you set in the purchase and sale agreement and used to make any potential adjustments to the purchase price. So how would this work in practice? Well, let's say that, use whatever units you want for this. Let's say your current assets are 75, your current liabilities are 45. That means your net working capital is 30. Well, let's say we get into one of those situations where, we have a big expense that happens right before closing. All of a sudden, our receivables and our current assets are the same, but all of a sudden we have a big expense that we haven't paid for yet, but that would be booked as an accounts payable. So it would increase your current liabilities, let's just say to 60. So now your actual net working capital is 15, okay? So there would be some sort of adjustment based on what the target would be, we're using the trailing 12-month average, and what the actual was. So this adjustment is 15. And since the actual was lower than the target, this would accrue for the benefit of the buyer. Okay? Similarly, if you were to say that, you had a big revenue windfall or a big order, revenues haven't been received yet, but they are in accounts receivable. Let's just say your revenue or your receivables go up to 100. Let's say your current liabilities look the same. Well, now your net working capital is 55, which is higher than the target that you set, so that there would be an adjustment of 25 that accrues to the benefit of the seller. Okay? So this adjustment really helps smooth out any of those unforeseen events that may happen between signing the purchase and sale agreement and the closing date. And so we mentioned cash, and I will just say one more thing. You mentioned the cash balance and why this is important. Let's just say cash was included. Cash was included in this, you include cash in your net working capital adjustment calculation. And let's say you decide, because you had a good year, to pay yourself a dividend. Let's just say cash is included here, you pay yourself a dividend of 25, right? So now your cash balance is lower by 25 because you paid yourself. So that balance is 50, this is 45. Now all of a sudden, your net working capital is 5. Well, the cash you paid yourself, remember, is 25. Well, this adjustment, guess what? It's 25. And so it really doesn't do you any good because that cash you paid yourself basically goes back to the benefit of the buyer through this working capital adjustment. So that also helps, these adjustments also help, prevent any manipulation by buyers or sellers with respect to any of these numbers. If a buyer tried to take out or a seller, tried to take out a bunch of cash before closing, this would allow some protection for the buyer to protect them against that. So that is the concept of a net working capital and a net working capital adjustment. Hope this was helpful. Hope you enjoyed this video. Once again, Ryan Wagner with Black Diamond Mergers and Acquisitions. If we can help you out with any of your needs with respect to buying and selling a business, we're here to help. Hope you enjoyed, and we'll see you later.